Hey everyone, and welcome. So, let's talk about a classic puzzle for investors. How do you choose the better company when at first glance, two businesses look exactly the same? It's a really common trap, but don't worry, there's a tool that lets us see right through this profit illusion. Let's get into it. Okay, so take a look at this. We've got two companies. Both are pulling in 1 crore in revenue, and both walk away with a net profit of 35 lakh. I mean, they look like identical twins, right? Based on these numbers alone, it's pretty much impossible to say which one is a better bet. So I've got to ask you, which one would you put your money into? It feels like a trick question, doesn't it? But the answer is just waiting for us, one layer deeper than that final profit number. See, the real key isn't just how much money a company makes, it's how well it makes that money. And that right there brings us to the star of our show today, ROC. That stands for Return on Capital Employed. You can just think of it as the real score, the ultimate efficiency rating for a company. It tells us exactly how good a business is at turning every single rupee it has into real, tangible profit. So what is it exactly? Well, ROCE is a ratio that measures how much profit a company squeezes out from all the capital it has access to. And that little word all is super important. We're not just talking about the money from the owners, we're talking about money from loans too. This gives us a much truer picture of how well the business is actually being run. Yeah, this really helps clear things up. On one side, you have capital, which is usually just the money the owners themselves put in. Shareholders' equity. But on the other side, you have capital employed. That's the whole shebang. It's the owner's money plus any loans the company has. It's basically the total amount of fuel in the company's engine. Okay, so we get the concept, right? Now, let's pull back the curtain and see how you actually calculate it. It's a pretty simple formula, but trust me, each little piece of it tells a really important story. And here it is. The ROCE formula is simply EBIT divided by capital employed. Now, we just talked about capital employed. That's all the money the business has to work with. So let's focus on the top part of that equation, EBIT. What in the world is that? EBIT. It stands for earnings before interest and taxes. And this number is absolutely crucial. Why? Because it tells you the pure, raw profit a company makes just from its main business operations. It's the profit before you have to pay interest to the bank or taxes to the government. It's the clean operational number. I love this slide. Think of it like a profit ladder. You start at the top with your total sales, your revenue. You take one step down, subtracting the cost of making your stuff, and you get to gross profit. Then you take out all the day-to-day operating expenses, and boom, you land on EBIT. It's the profit that the management team is 100% responsible for, just from running the business well. All right, now that we've got a handle on EBIT, let's circle back to our original mystery. It's finally time to use what we've learned and figure out which of our two identical companies is actually the better business. And here we go, the big reveal. Look at that. Just look. Even though their net profit is the exact same 35 lakh, their EBITs are worlds apart. Company 2 generated a massive 85 lakh in operational profit. Company 1? Only 60 lakh. It's clear as day. Company 2 is way more efficient. It has lower costs, it's just run better. The only reason their net profits ended up the same is because Company 2 had to pay a lot more in interest and taxes. So here's the bottom line, the thing you have to remember. EBIT shows you the genuine, unvarnished earning power of a company. It's the report card for the management team. It tells you how good they are at their core job, keeping expenses low and running a tight ship. A higher EBIT, like Company 2's, is a huge sign of quality leadership. Okay, a quick heads up. When you go out into the real world of investing, you'll notice that different people, different analysts, calculate capital employed in slightly different ways. But don't let that throw you off. There's one method that's it's more logical than the others. You'll usually see these 3 common approaches. And notice, the top part of the formula, EBIT, it always stays the same. The only thing that changes is the bottom part, the capital employed. Some people use only long-term debt, others use all liabilities. But there's a better way. From my money, the most sensible, the most logical way to do it is the third one. Equity plus all loans, both short-term and long-term. And why is that? It's simple, really. It's the most honest approach. It counts every single rupee the company actually has at its disposal to make a profit. It doesn't matter where the money came from. So, if we use that logical formula on our clear winner, Company 2, we get a rocky E of 0.28. Or, to put it another way, 28%. So what does that mean? It means for every 100 rupees of capital that company put to work, it generated 28 rupees in pure operational profit. Now that is a powerful, clear number that tells a fantastic story of efficiency. So, what's the big takeaway for you? How can you actually use ROCE to be a smarter investor? Well, it really just boils down to two key things you need to do. First, never just look at 1 year's ROCE in isolation. You got to look at the trend. Track it over, say, 5 or 10 years. Is it getting better? Is it stable? A consistently high ROCE is a beautiful thing. And second, context is everything. You have to compare a company's ROCE to its direct competitors. Is it the leader of the pack, or is it falling behind the others in its industry? And there you have it. You now have the tool to look right past that flashy headline profit number and see the real story, the operational efficiency of a business. So the next time you're looking at a company, you have a choice. Are you going to believe the simple profit story, or are you going to dig a little deeper for the efficiency story? The answer could make all the difference.